Hello, everyone. Welcome to the webinar today. So glad to have you with us. My name is Alexandra Alvarado, and I'm the Director of Education here at the American Apartment Owners Association. So as all of you are coming in, I'd love it if you could put in the chat where you're coming in from. So let us know where you're coming in from in the chat. You can just say hello. That would be great, just so that we know everything sounds and looks okay and that we can see where you're coming from in the chat. Great. Thanks for the thumbs up, guys. So before we begin, I did want to just mention a couple things. So first off, as you might be able to tell, we are recording this webinar, and we will be sending you the full recording and the slides tomorrow, along with our speaker's contact information and any other resources that he might provide. Also, we'll have about 45 minutes or so of presentation time, and then we'll end with some Q&A. So please put your questions in the Q&A box, not the chat. That helps us to keep track of everything in one place. So Q&A box is for questions, chat is for comments. Again, if you want to tell us where you're coming from in the chat and give us a hello, I love seeing familiar names in there. I know some of you come to a lot of these, and today's topic is going to be a slightly different angle than the normal 1031 exchange sort of webinars you might have heard about before. So I hope that you'll all learn something a little new from Richard Gann, or Rick. Rick has spoken with us, quite a few times now, but I'll give you all a brief intro. He's the managing partner at 1031 Capital Solutions. He's a graduate of UCLA and California Western School of Law. So he has a legal background. He's been a member of the state bar since 1997, but now he is a tax strategist, and he does so really to help landlords, to help individual real estate investors retire from being a landlord. And he's been a great asset to our members for several years now. He has a background not only in law, but in also other financial services, real estate broker. So he knows the world we're talking about, and he works with lots of different people in real estate and can probably help you come up with a really great plan. So with that said, I'll transition this over to Rick to take it over from here, and I'll come back during Q&A. Thanks, Rick.
Thank you, Alexandra. I was feeling nice and young this morning until you reminded me how long ago I graduated from
I know
law
I said the
school.
year. I was like, wow, a lot of
30 years.
experience.
Yeah, 30 years next year. So
Wow.
anyhow, thank you, everybody. Thank you for joining the webinar. My name is Rick Gann, and I'm, as Alexandra mentioned, one of the two managing partners of 1031 Capital Solutions. Many of you have probably heard a lot about Delaware Statutory Trusts, or DSTs, but today we are going to touch on two options for investing in a passive replacement program beyond conventional DSTs, which are real estate investment trusts, or REITs, and 1031 qualified mineral rights investments. Before we get started, I am required to make a few disclosures, which some of you have heard many times by now. This presentation is not a solicitation. There are material risks in investing in DSTs and REITs, including loss of principal. No secondary market exists for these types of programs. Mineral rights are also illiquid investments, are speculative, and involve a high degree of risk. The fees and expenses associated with packaged real estate securities programs are typically higher than traditional real estate. These programs are sold as private placements and therefore are only available to accredited investors. And this presentation does not constitute tax or legal advice. A little bit more about us. Again, for those of you who have joined me multiple times, this is probably old news, but the branch offices in our network are in San Diego, where my partner Jason McMurtry is, in Sacramento, in Colorado, and in Seattle, where I am currently. In addition, we have folks working remotely in Portland and Los Angeles. I encourage everyone to visit our website, 1031capitalsolutions.com, where we have copious articles, blogs, videos, and educational content. In a nutshell, we are a financial services firm that exists for the purpose of helping individual property owners retire from being landlords. And on that note, in 2020, we published a book on this very topic, which is available in both print and electronic formats on Amazon. However, if you go into our homepage, and I think we also make this available to viewers on this seminar today, we will provide you a hard copy of the book delivered right to your door. And as Alexandra mentioned, we do intend to provide time for Q&A, but if somehow we do not adequately address a subject or answer your question, you are welcome to schedule a call on our website. So before we talk about any specific replacement options, I want to briefly remind everyone how a 1031 exchange actually works from a tax perspective. A complete 1031 exchange, meaning a full replacement of both the relinquished property's value and any paid off debt, allows an investor to defer all federal and state capital gains taxes at the time of sale. Initially, this is a deferral, not a forgiveness, meaning the tax obligation is carried forward into the replacement property. In the absence of a 1031 exchange, a typical taxpayer would be subject to 20% federal long-term capital gains tax on appreciation, 25% depreciation recapture tax on prior depreciation, 3.8% net investment income tax for many higher income investors, plus state income tax, which can range from 0 to well into the double digits depending on where you live, and of course it's highest in California. When you add those together, the total tax cost can easily exceed 30 to 40% of the gain in most cases. And the diagram on the right illustrates what many investors do in practice. They sell property 1, complete a 1031 exchange, roll into property 2, deferring the taxes, and then later they may exchange into property 3, continuing to defer. And this is why you'll often hear the phrase swap till you drop.
Hi, Rick. You could share your screen. I don't think it's actually sharing. It sounds like you might want us to see some diagram on your screen. So just wanted to give you the heads up.
I'm just a little flow chart of the box to the next box. Do you not see that?
No, we're not seeing anything on the screen share.
Oh. Hmm. What about now?
No, not yet.
So there's just nothing on the screen at all?
No, just your face, but that's
Oh.
okay. So, I
Uh,
mean, I can pull up your slides. If you've sent them to Christine, I should have them in our folder. Oh, there it is.
oh, this entire time I thought you were seeing the slides.
It's
Okay.
okay. There we go. Okay. I think we can all see the slides, right, guys? So you can go ahead and get started or continue, I should say.
Thank you. Sorry about that, everyone. That's the weird glitch. So on to the next slide. And well, here we go. As a reminder, we were talking about just reviewing the basics of 1031 exchanges. So thankfully, I, I don't think there's a whole lot that most of you aren't already aware of, but I do, anytime I'm talking about 1031 exchange, just want to make sure that we put things into context. And so on the last slide, what I was talking about is the taxes that you'd be subject to in the absence of a 1031 exchange, and the typical approach of not only kicking the tax can down the road, which is of course a benefit in and of itself, but most importantly, the fact that we combine the deferral of a 1031 exchange ultimately with the step up in basis. And that's the key estate planning component. Under long established tax law, as most of you know, a full step up in cost basis at death eliminates all previously deferred capital gains and depreciation recapture taxes. In community property states, including California and Washington and Arizona, there can even be a full step up at the death of the first spouse, which obviously is especially impactful for married couples. So again, in this simplified example, the heirs receive the final property with a new cost basis, meaning that deferred taxes are effectively eliminated, not just postponed. Then we get to the typical timelines that you're all familiar with. You must identify your potential replacement properties within 45 days of close and complete your purchase within 180 days. There are no exceptions to these deadlines unless the federal government issues a regional extension relating usually to a natural disaster, or as we saw for the first time a few years ago, a national deadline extension due to a pandemic. In the case of passive replacement programs, we rarely worry about either the 45-day or 180-day deadlines because our investors usually complete their exchange within the first 2 weeks after closing the sale of their relinquished property. So the rules are good to know, but in our case, we are almost always getting our clients reinvested in their exchange long before they have to worry about complying with these IRS deadlines. As I mentioned earlier, a basic caveat of achieving complete tax deferral is the requirement that a taxpayer replace the entire value of their downleg property. For 1031 exchange purposes, the replacement value is not the full sale price, but rather the sale price minus commissions and other customary transaction expenses. However, even if you paid off a loan in a 1031 sale, you still have to purchase a property of equal or greater value. In other words, to defer all taxes, you must replace all your equity and all your debt. And the reason I bring this up is 1031 DST and 1031 REIT programs often provide an opportunity to replace your existing debt without being a direct party to a new loan, which is a considerable benefit to folks who are either unwilling or unable to go through the process of securing their own financing. So let's talk about the applicability of the topics in today's webinar. The most common client scenario we see is an individual owner of a rental property who, for any number of personal, financial, or regulatory reasons, wants to sell a property and reinvest 100% of their net sales proceeds into a portfolio of what we call passive replacement programs. The factors driving landlords to sell their properties, particularly owners of rental housing like AAOA members, include increasing legal liability, screening regulations, security deposit restrictions, annual caps on rents, eviction procedures, just cause tenant removal restrictions, negative demographic trends, increased state and local taxes, and lots of other macroeconomic factors, maintenance hassles, mold abatement, and looming capital expenditures like an upcoming roof replacement. And again, for most of our clients, and likely for most of you on this webinar, whatever they are selling is the last rental property that they ever want to self-operate. Based on all these motives, most of our clients will reinvest, again, their entire proceeds into passive replacement programs. But from a purely financial perspective, arguably the most compelling reason to replace a single rental property is the fact that your equity over time has increased faster than your annual rental revenue. This is a common phenomenon in California and in the Seattle market, particularly with respect to single-family residential properties that are worth more to a future owner-occupier than an investor. People who own highly appreciated houses, townhomes, and condos are effectively able to arbitrage the difference in value between their property as a rental and its value as another buyer's home. Combined with the mathematical impact of paying down debt over time, our clients typically are sitting on rental properties whose net yield as a percentage of their current equity is less than 3%. In other words, if you are in this category, you are no longer receiving a yield that is commensurate with the hassle and liability of owning rental housing property, particularly in California, Oregon, and Washington. And unfortunately, due to the long-term trends of negative net domestic migration, job losses, skyrocketing insurance costs, increasing tax burdens, many submarkets on the West Coast, frankly, are no longer a safe bet for continued appreciation. We obviously don't have a crystal ball, but I can say with confidence that the real estate market on the West Coast for the next 20 years is simply not going to look like the last 20 years. So now that we've set the stage for a 1031 exchange and a 1031 investment generally, let's delve into the most common alternatives to self-owning and operating a rental housing property. For those of you looking to sell a property of at least $2 million in value, you may be pitched the idea of buying a single tenant fast food restaurant, typically in some small market in the Midwest. I am bombarded with these emails every week. And while this may be a more passive investment than your current housing rental, these types of properties typically carry the same three common risks. First, you are entirely reliant on the financial strength of the franchisee occupying that property. Second, if the franchisee vacates the property, the costs of re-tenanting the property can be incredibly high. And third, you still have direct ownership liability as well as exposure to structural expenses that may not be included in the terms of the net lease. I could go on and on this, but frankly, if you'd like to become the owner of a drive-through fast food restaurant, taco stand, etc., you can find any number of real estate brokers who will help you find something in that category. That's not what we do. And so I'm just going to set aside that option. But in fairness, that is technically a passive, probably a more passive option for you than owning and operating your own rental housing property. The next option is a fractional ownership interest in one or more properties held directly by a Delaware Statutory Trust or DST. And just for quick review, a DST investment is qualified as like-kind replacement property under Internal Revenue Code Section 1031 under a revenue ruling from 2004. And we are now 22 years into the growth of the 1031 DST industry. Most of our clients, like some of you on this call, have invested in DST properties that offer passive ownership, institutional management, built-in financing, and hopefully a reliable income stream that lasts 6 to 8 years until the property is sold. Once a DST property liquidates, investors have the option to receive the proceeds and pay the taxes, or 1031 exchange into another property, which is usually another DST. But of course, today's webinar is not about traditional DSTs. Instead, we are talking about REITs, and more specifically, fractional interests in properties that are slated to be transferred into a REIT, and mineral rights, both of which qualify as passive 1031 replacement properties. While all these options start with a 1031 exchange, pre-REIT properties and mineral rights have distinctly different attributes than DSTs. And so in a few minutes, I'll dig a little deeper into how these programs work. But to determine which of these categories may be worth considering, let's walk through a handful of general questions. And this is a new element that I'm trying out, so I appreciate you indulging me, but sometimes it helps to get some questions answered first and then look for solutions rather than just presenting the solution outright. So I'm going to walk through a series of questions that may or may not apply or resonate with you, but this exercise I think really helps narrow down what options might ultimately be worth considering. And the first question is it important that you retain the ability to exchange your pending replacement property back into a traditional rental property that you own and operate? So if you're doing a 1031 exchange, how important is it to you that you be able down the road to maybe going back to owning another rental property and self-operating that rental property? If that's important, both a conventional DST and mineral rights interests would be potentially suitable because these investments can be sold into another future 1031 exchange. A pre-REIT property, on the other hand, is destined to be converted to REIT operating partnership interests, and after that is no longer qualified to be exchanged under Internal Revenue Code Section 1031. In other words, when you invest in a pre-REIT property, you are committing to a particular REIT as your eventual long-term investment. Conversely, would you like to avoid the process and transactional expenses associated with future 1031 exchanges? If so, both a conventional DST and mineral rights interests would not be potentially suitable because these investments eventually require a future 1031 exchange if you want to continue deferring taxes until you pass away. A pre-REIT strategy, however, only requires the one 1031 exchange that you would conduct coming out of your current rental property. Next question. Do you only need to fill a stub amount in your 1031 exchange rather than invest all your net proceeds into a passive replacement? As an example, did you sell a property for $2 million, find a great $1.7 million replacement, but now have a $300,000 gain problem because you've got a chunk of money that you didn't replace in your exchange? If so, you likely would not want to invest in a pre-REIT property because, again, you may want to 1031 exchange that equity back into some other traditional property in the future, and you would be precluded from doing so in a REIT. Okay, next question. Do you need multiple options to replace a high amount of debt from your relinquished property? In this scenario, your best bet is going to be a conventional DST because most of the pre-REIT properties come with no or low levels of built-in leverage, and mineral rights programs have no built-in financing at all. So if needing to replace debt, and particularly a high amount of debt from your relinquished property, that points towards a conventional DST. More on that point. With most conventional DST programs, the typical loan terms include 30 to 55% loan to value, some are higher, a 10-year term loan, typically fixed rate or capped, but effectively fixed, interest only for the first 5 to 10 years. Once the loan amortizes, it usually amortizes on a 30-year schedule, sometimes assumable by the next buyer of that property. Sweep and reserve conditions often apply, and there are usually prepayment penalties for the DST. But those are the general loan terms. But whether it's a pre-REIT property or a conventional DST, with all the passive replacement programs that include built-in financing, it's important to note that there's no loan qualification to the investor. There's no application. The bank doesn't know who you are. There's no personal liability, no loan repayment responsibilities, no notarized closing docs, no public record tying you to the loan. Your old loan falls off your credit report, and there's no longer a new loan on your credit report. And yet, you are able to replace your existing debt for 1031 exchange purposes. Another question. Is it important that you diversify your investment across numerous sectors, tenant types, and geographies? If so, the clear winner here is the pre-REIT strategy. While your initial 1031 replacement property may be a large apartment community or a small portfolio of commercial properties, in a couple of years, you end up owning operating partnership units of a large, diverse, multi-state portfolio, typically valued in billions of dollars. Of course, it's possible to construct a fairly diverse mini portfolio of conventional DST properties, but not one that compares to the inherent diversity of a REIT. So the point here is if diversification is of paramount importance in your replacement, then going the pre-REIT route is likely the best option. Based on your goals, needs, and risk tolerance, is your primary focus on capital preservation and income stability? Investing in mineral rights involves a much broader range of upside and downside risk, as well as variability in royalty income. So mineral rights would be automatically precluded for somebody focused exclusively on capital preservation and steady income. It is certainly possible to experience capital preservation and reliable income from a conventional DST, but I'd have to give the edge here categorically to the REIT strategy. Conversely, are you willing to tolerate greater fluctuations in income and possibly risk to capital in exchange for a greater potential for appreciation? Here, the opposite is true of the last slide. Over a typical investment hold period, mineral rights probably have the highest potential for total return, depending largely, obviously, on the supply and demand of oil and gas during your investment period. So again, for someone focused on capital preservation and stable income versus someone who's willing to get out of their comfort range in exchange for higher potential appreciation, you're going to have different plots on the spectrum of what's most suitable for you among the different passive replacement options that we have available. And lastly, do you want a 1031 replacement that is easier for your family to inherit compared to a rental property? And I think it's safe to say that all these options are less burdensome for your children to inherit than the current rental property that you own and manage. So let's describe how all this works. Going back to 2010, when Delaware Statutory Trust, DSTs, really started taking off, every program had the same exit structure. You would exchange into the DST property upon selling your rental property. Then the DST sponsor would administer that property for 6 to 8 years. The DST sponsor would then sell that property to a third party out in the marketplace. And then the DST investors would have the same 3 exit options that you have today, meaning either pay the taxes, exchange into another DST, or exchange back into traditional real estate. And that was basically the same general flow for every DST investor. Then, starting really just a few years ago, we began to see more DSTs structured as pre-REIT programs, in which a large, often public real estate investment trust selects a property from its existing portfolio, repackages it as a DST, holds it as a DST for a couple of years, and then repurchases that same property back under what's called a 721 exchange. Under Internal Revenue Code Section 721, the owner of a property, in this case a DST property, can contribute the property to a REIT partnership in exchange for partnership units without recognizing any taxable gain. And today, more than half of all 1031 DST dollars are being invested in these pre-REIT offerings. It's a significant change in the investment landscape in a relatively short amount of time. The technical term, by the way, for REITs that can utilize Section 721 is Umbrella Partnership Real Estate Investment Trust, or UPREIT. But because virtually all syndicated REITs are structured as UPREITs, we usually drop the up and just call them REITs. But if I say REIT or UPREIT, those are interchangeable. Most of these programs are non-traded REITs that operate analogous to a mutual fund, meaning the REIT sells and redeems interests directly from investors rather than listing shares on a stock exchange. And if you're in the REIT for 12 months following the conversion, subject to the overall limits of the redemption program, you may request a redemption for any dollar amount up to the full amount of your investment value. Of course, liquidating interests in a REIT partnership is a taxable event, and as I mentioned earlier, such interests cannot be further exchanged on a tax-deferred basis. But for a lot of clients, just knowing that you can get access to that capital, even if it's taxable, it gives comfort, and it allows people to feel like they've got now an asset that they can tap into in an emergency, or if there was some other opportunity that you just couldn't resist, in a way that you couldn't do with any other type of real estate where you can't just pull money out of. So it's a unique potential liquidity opportunity once you've been invested in a large REIT after a year following a DST conversion. Under the pre-REIT strategy, as I mentioned, investors do lose the ability to conduct a future 1031 exchange, but ultimately end up in a more diverse portfolio that is slightly more estate friendly than a conventional DST. I should note, however, that REIT investors receive K1s, and the tax reporting may be a little bit more involved than a typical DST. However, almost all the REITs that we work with, and I think maybe all of them, offer a state return on behalf of investors to all the states that are in the portfolio, and that really does ease the burden of having to do the tax reporting by reporting in aggregate on behalf of the investors. Now, from a purely investment-based point of view, the key difference with a pre-REIT strategy is that, the key difference is that you are only investing in the initial 1031 replacement property for a couple of years. And then ultimately your equity rolls into the REIT. And unless you cash out and pay taxes, you spend the rest of your life, frankly, invested in a typically multi-billion-dollar portfolio of institutional real estate assets. In the conventional DST strategy, you are always invested in one or a small handful of properties, but with the opportunity to exchange out of that property every 6 to 8 years. So to recap the pre-REIT strategy, you start off as the sole owner of a self-operated property, the rental property you own today, typically with only one or a few tenants. You then sell your property, and after a 1031 exchange, become the fractional owner of an institutional portfolio, typically with multiple tenants, sometimes hundreds of tenants. And then finally, after 2 to 3 years, we conduct a transfer of your interest in that first portfolio under Internal Revenue Code Section 721, in which your fractional property interests are converted to operating partnership units of a diverse multi-billion-dollar REIT portfolio. Those are the steps in what we call the pre-REIT strategy of going from owning your rental property today to being essentially a fractional owner in a multi-billion-dollar institutionally operated portfolio. Under the mineral rights strategy, we start with the same investor, typically someone selling an actively managed real estate property and completing a 1031 exchange. However, instead of owning a fractional interest in one or a handful of rental properties, you are exchanging into interests that consist of strategically aggregated mineral rights deeds, all held together initially inside a single LLC, what I call a basket of mineral rights. Each investor's interest is recorded at the county level, reflecting fractional ownership tied to the underlying mineral deeds. And this is important. The investor is not purchasing a security interest in future production alone, but a property ownership interest that is structured to qualify as like-kind replacement property under Section 1031. So for those of you who are familiar with investing in drilling programs or other aggregated funds in oil and gas, there is a whole spectrum of different ways to invest in energy. This is the purest form from a real estate perspective, in that at the end of the day, you are buying mineral rights deeds, fractional ownerships in deeds that are recorded with your name at 127 different counties. And because of the fact that you're investing in this basket of mineral rights deeds, your investment qualifies under Section 1031 as replacement property, because you're actually buying real estate that qualifies as like-kind real estate for purposes of Internal Revenue Code Section 1031. Obviously, the actual drilling and operations on those properties are handled by experienced operators, not the investors themselves. In fact, these mineral rights do not represent an ownership interest in the wells or the companies who operate them, but rather, again, a recorded right to receive royalty interests based on the value of the minerals being pumped out of the ground on those properties. Those royalty payments flow from the operators through the structure administered by the program sponsor, and then ultimately to the 1031 investors. And again, investors are not responsible for operating costs, drilling decisions, or day-to-day management. Think of royalties as a form of rent required to be paid to whomever owns the recorded mineral rights of the underlying parcels. Now that we've covered how the structure works mechanically, the next important piece is understanding what actually sits underneath a royalty portfolio like this. There are 4 common well categories you'll hear referenced in 1031 mineral rights programs. Each category represents a different stage of development and a different risk and cash flow profile. Starting at the lowest risk end of the spectrum are PDP wells, proven developed producing wells. These are wells that are already producing and generating royalty income today. From an investor's perspective, PDP exposure tends to provide more immediate cash flow and greater visibility into near-term performance. That said, even producing wells are subject to a natural decline over time, and production levels can change. But think of PDP wells as the wells that are generating oil and therefore cash flow already. Next are DUC wells, meaning drilled but uncompleted. These wells have already been drilled, but they haven't been completed and tied into production. And they represent capital that has already been invested by the operator and potential future production if and when the operator completes the well. There's no guarantee that a DUC well will ever be completed or generate royalties. So obviously that's a built-in risk. Then permitted wells. They are what they sound like. These are locations where the drilling site has been selected and the operator's permit application has been approved. At this stage, the operator has regulatory clearance, but no drilling has occurred yet. These wells carry a little bit more uncertainty, but also more optionality depending on market condition and operator decisions. So they're basically, waiting to launch, and obviously the biggest factor in whether an operator decides to move forward with a permitted well is what's happening with the current and projected price of oil. And then finally, we have PUD sites, proved undeveloped reserves. These are presumed economically viable well locations on undrilled acreage. They represent long-term potential and future development optionality. They are not producing, and frankly, they may never be developed, but they are often included to provide upside exposure over time. And so this bar chart on the right shows a hypothetical example of how value allocation within a mineral rights portfolio might evolve over time. Early on, the portfolio may be weighted more heavily towards the PDP wells, providing current income at that time. But as we progress, if development occurs, value can shift toward DUCs and permitted wells and then PUD sites. Remember, there's no guarantee that any well will progress through these stages, and there's also no guarantee that a PDP well will generate royalties for any particular period of time. This framework is about categorizing risk and potential, not predicting outcomes. So when we talk about diversification in a royalty program, we're not just talking about geography or operators, we're also talking about diversification across development stages. And that mix influences current income, future income potential, and the overall risk profile. The idea, of course, is for the sponsor is to curate, as the kids like to say these days, a basket of mineral rights located across multiple states and hundreds of counties potentially, where all of these different underlying properties have multiple wells across all of these different categories, so that over the life of your investment, you've got income being generated now, income being generated the next year, the next year, the next year, all coming from wells that are going through different stages. And if this is all reaches potential, then you've seen, hopefully combined with good timing on the price of oil, significant royalty income off of collectively this basket of mineral rights that you've invested in a 1031 exchange. Finally, it's important to touch on key considerations like limitations, fees, and risks. In a typical DST and REIT structure, the sponsor buys a property, packages it up as a DST, and then resells that property a few weeks later with a marked up price. Under state and federal securities rules, the sponsor is required to provide a detailed description of the full use of investor proceeds, including the original property purchase and all categories of the markup. The four major categories of a DST markup are reserves, syndication costs, sponsor fees, and transaction expenses. In a conventional DST, because a real estate sponsor earns most of their profit over the life of that property from the acquisition fee, the markup tends to be higher than in a pre-REIT property, in which the sponsor will potentially receive annual management fees, for decades. So that fee structure gets to be spread out over time, and therefore allows the sponsor to structure the deal without needing to front load the fees as much as you might see in a conventional DST program. Whether it's a conventional DST or pre-REIT program, the entire balance of your bank account at the qualified intermediary is wired to the DST, and that entire amount divided by the equity offering of the DST determines your ownership interest in the property. But understand that you are indirectly paying for the markup expenses because they are already built into the price of the offering. So on the topic of pre-REIT properties, I will close by repeating some of the most important considerations when investing in this type of structure. General real estate risks still apply. There are no guarantees. A client's income and principal are still at risk. 5 to 10 years is the typical hold period for a conventional DST, 2 to 3 years for a pre-REIT program. DSTs are illiquid until the property is sold or until 12 months after a 721 UPREIT conversion. Investors must be accredited and meet general suitability requirements. We typically rely on the net worth test under SEC regulations, which requires an investor to have a net worth of at least $1 million, excluding their home. 1031 investments, as you all know, require strict compliance with forms and deadlines. And as we just discussed, program fees and expenses are higher than conventional real estate. And of course, corresponding limitation fees and risks apply equally to 1031 mineral rights programs, with the most obvious distinction being the exposure of these programs to swings in oil and gas prices and the risks that future wells may not meet original production estimates. Bottom line, despite being qualified for a 1031 exchange, the suitability and risk profile of investing in a basket of mineral rights is nothing like investing as a fractional owner in an apartment community. So these are distinctly different investments that have, frankly, nothing in common with each other than qualifying for a 1031 exchange, but might represent a way to get some significant diversification out of your portfolio by getting some exposure, for those of you where this is suitable from a risk tolerance perspective, in mineral rights that are going to react to market conditions much different than a typical net lease property or apartment community. And with that, Alexandra, I've concluded my comments. Excuse me. I think we're right at the 46-minute mark, and maybe we can take a few minutes for some Q&A.
Yeah, absolutely. I just put up a poll question as well. If you did want a consultation to talk about this, or really any way that you can prepare for retirement or just exchanging your rental property, go ahead and say yes there. I'll leave that up. And then if you say yes, I'll connect you with Rick, so it'll be a little faster. We did get a couple questions already. Again, everyone, if you can put your questions in the Q&A, please, and not the chat, we can check there. So the first question is more general 1031s. Is it best to change a deed to a TIC for spouses who want to do different things with their half of the 1031 property sale? So, for example, the wife can invest in a different 1031 exchange vehicle than the husband who wants to buy another property, especially if they're planning a divorce, for example.
Well, planning a divorce is a little different. It is certainly cleaner from an audit perspective to, especially if you're anticipating on a long-term basis, no longer co-owning the property in anticipation of separation or divorce. It is cleaner to re-record the deed in that manner. Again, usually you're doing this under court supervision or pursuant to a divorce decree. But the short answer is you can do it that way, and that is cleaner, especially if the property has been allocated in such a way that now those properties are going to be reported on separate tax returns. If you're not getting a divorce, then it is not necessary to re-record a deed as tenants in common in advance of buying two properties that were previously owned as joint tenants by a married couple, especially if you're going to continue reporting those properties under one spouse's social security number. But all in all, I do think it's a good idea from an audit perspective to re-record as tenants in common in anticipation of a divorce.
Okay. And then Frank is asking, if you own several properties and you rent them out for 10 plus years and then decide to do some changes, like put all the property into a single member LLC and also put that LLC into a revocable joint trust. Then can you 1031 any of those properties at any time without the LLC having a track record of rentals of more than a year since they changed ownership when you move them over?
That's an
Um,
excellent, good
mhm,
question. Yeah, in the context of a single member LLC, the simplest example where a person has created an LLC purely for liability protection and owns one or more properties in an LLC, and further, you are essentially just reporting all that on your individual tax return and just passing through the LLC to your individual tax return. The the IRS essentially doesn't distinguish between you and a single member LLC for 1031 exchange purposes. Same with a revocable living trust. If there are multiple parties involved and the LLC it now has multiple parties and the LLC is reporting taxes separately under its own EIN, then you can still do a 1031 exchange, but you're going to need to exchange those properties um, as the LLC. So it really does depend on whether your LLC is merely a single member disregarded LLC that the IRS already ignores for tax purposes, or is it an entity that is operating separately with multiple people with its own tax ID and is reporting its taxes separately. Then you need to treat that as an entity, and it needs to do those 1031 exchanges and as an entity. It um, whether or not you need to have held that property for any period of time, there's no hard and fast rule, but it's a good idea to have at least done one uh, tax return for that LLC owning that property before doing an exchange, to avoid the IRS questioning your intent at the time of the exchange. That's something you're going to want to talk to a tax attorney on to get a specific recommendation on, because 10 CPAs or attorneys are going to have 10 different opinions on how long you need to hold a property in a new entity before you can do a 1031 exchange. So I'll leave it at that.
mm. Yeah, I always thought it was interesting that the law doesn't actually say a specific number of years. It's kind of vague, but it's like, what does it look like, I guess. So another question is key here. He's asking if I own a building with 50% LTV that is worth, say, $1.5 million. What do I get if I exchange for mineral rights? What would be the yield?
Well, so you said you had a loan or loan to value. Right off the
Mhm.
bat, you wouldn't, in your scenario, you would not invest exclusively in a mineral rights program, because the mineral rights programs, as I mentioned earlier, do not have built-in financing. The DSTs and the pre-REIT programs often do, but mineral rights do not. So in your scenario, we would most likely need to break that up and invest most of your equity into a program that has enough financing so that you can replace, in your scenario, the $750,000 loan that you've got. And then, there might be a small amount left over that doesn't need to have debt associated with it that we could put into mineral rights. But I just want to make it clear again that that right off the bat, the mineral rights, 1031 qualified mineral rights programs are not suitable for people who need to replace debt because they don't have built-in financing.
Hmm. And what would be the yield if he were able to?
Well, again, this is a stark difference between our typical DST or pre-REIT program, where the private placement memorandum offers a 10-year projection, and on a net lease portfolio, they can predict, almost to the penny what your yield is likely to be. Obviously, you can't do that with multifamily or self-storage or something like that. But we can give very concrete projections in terms of the current year, and then going forward, how accurate those projections are depending on the lease structure. I, in a mineral rights program, uh, there's only the broadest range because what you're investing in or in mineral rights, where the royalties being paid are a function of oil and gas prices that are fluctuating on a moment by moment basis. So the yields are typically, frankly, much higher than conservative real estate programs for sure. But they don't even put just they don't even include a yield in the offering memorandum, because at the time that they generate the offering materials, even at that point, they can't project even a few months later what the yield is. So the mineral rights programs are really for people who are willing to understand. And I made this point earlier, that you have to go into that letting go of knowing what is going to be, what are the payments going to be, and making educated guesses on that based on projections of oil and gas prices.
Okay.
But it can be as high as double digit, by the way. It
Less
varies with real life.
predictable.
Yeah.
Yeah, that makes sense. Stephen here asking, why am I unable to sell my apartment complex and 1031 exchange the funds into a publicly traded REIT?
A REIT in and of itself does not qualify for a 1031 exchange. Interest in a REIT, long ago, the IRS made it clear that when you invest in a REIT, that the shares of the REIT do not constitute replacement property in a 1031 exchange. In a REIT, you're either investing in the partnership, the limited partner portion of the REIT as a limited partner, or for a lot of public companies, the common shares are held in the corporation that is the general partner of the REIT. So you're either buying corporate shares or limited partnership interests, neither of which are real estate for 1031 purposes. So what the industry has evolved into now is a way where you can effectively get into the REIT partnership, but it's a two-step process where you're investing in a property, and then the REIT is absorbing that entire property, bringing it into the REIT, and then exchanging REIT interests for DST interests. So when I talk about a pre-REIT property, it's that two-step process where you have to invest, you have to 1031 exchange in that first property so that the REIT can reabsorb that property back into the trust, and then exchange the REIT interests under not a 1031 exchange, a 721 exchange. By the way, for that apartment building that you own, if you found a REIT somewhere that was willing to take that property that you own, you could do a direct transfer yourself. In other words, you could get the REIT to agree to absorb your property in exchange for giving you limited partnership interests in the UPREIT. People do that. It's just that most of our clients, and probably most people on this call, do not own the type of institutional real estate that these REITs acquire. And so, even a 10-unit apartment community is not the target property for an institutional REIT. They're buying Class A, 300-unit apartment complexes, not the stuff that's mom and pop operated.
Okay, that makes sense. Claire is asking here, I think you kind of answered this, out of all of the options possible with the 1031 exchange, is there anything that allows for shorter term investment, say 18 months to 2 years? If so, can it still be financially viable due to the level of fees that are likely to be involved?
Well, that's an excellent question. And the fees would be part of that, because I'm the first to tell you, in these programs, you have to factor in that the cost of packaging up these programs and then syndicating them and all the layers of due diligence and the people that touch these programs does inherently make them more expensive. what you're paying for that extra expense, of course, is not having to negotiate, source, um, finance, operate, manage, or sell the property or be responsible for any of that. So you have to assign a value to the passive nature and institutional nature of these investments. But to answer your question, generally, none of these syndicated programs, even if the cost was such to justify a short investment period, none of them are designed for someone to get in and out in a short amount of time. Also, keep in mind that if you made a habit of selling properties, getting in and out of properties in 1031 exchanges, you're setting yourself up for IRS audit, and then you get treated as what's known as a dealer, where your property ends up being treated as inventory rather than real estate, and you're precluded from benefiting from a 1031 exchange. Your best bet, if you really need to have a short turnaround, is to just go buy a property that you can sell at your discretion, as on a temporary basis.
Mm,
But nobody has solved for, and I get asked this question all the time, nobody institutionally has solved for a product or a solution that allows for someone to get in and out in an 18 to 24 month period, because just at the institutional level, these programs just aren't designed for that type of liquidity.
yeah. Okay. Frank is asking, so if you've already done a 1031 exchange and it is in your name, he says the 1031 is in a DST already. Can you put it into a revocable joint trust? And then how is it done?
We
Are
do this
there,
all
yeah.
the time.
Oh,
We
good.
we we re-register DST interest all the time. It's actually much easier than re-record. There was a question earlier about re-recording a deed.
Mhm.
Re-recording a deed is a hassle, and you have to fill out preliminary change of ownership reports, and you got to get notarized, etc. So at the DST level, the DST sponsor essentially maintains a ledger or registration of ownership, and if a client, after doing a 1031 exchange, has established a new living trust, is the most common example, then it's a simple form, and your DST interest is re-registered in your trust, and you're done. The other common example is someone who owned an LLC, did a 1031 exchange. The only asset that LLC had was the property that was sold. The client doesn't need to maintain the LLC anymore. And so we are routinely helping clients who are dissolving the old LLC that they don't need anymore, and then changing the title of that DST interest from the LLC either to their name or into their revocable living trust.
Well, that's good news. Donna is asking, last question here from what I can see. Are the mineral rights vehicles restricted to oil and gas? Are any non-energy mineral rights available for 1031, like metallic mineral deposits?
Yeah, I know the term mineral rights is a little bit of a misnomer because I it implies that there could be a broad group uh, uh, of revenue generation in this context, and although theoretically a mineral rights deed could cover the ability to extract non-petrochemical minerals, in this context, the term mineral rights really is basically petroleum or natural gas. Um, there's no market for mineral rights deeds where someone is getting paid royalties on because someone is pulling um, platinum or copper or gold out of the ground. But good question. But no, in this context, mineral really means oil and gas.
Okay, great. Rebecca is asking, are there any solar farm DSTs?
I recall seeing a solar farm program years ago, and so the short answer is yes, but I have not seen one. It's been a really long time. I believe me, I would love to see some sponsors come out with some programs, where there's some green energy involved, et cetera. It's just tough because they have to generate, at the end of the day, people invest in DSTs because they want, a reliable income stream. And, we just haven't seen any programs where someone can buy a property and generate the yield that people want to see from a solar farm. And, until someone can structure that, probably aren't going to see that, but
Mm.
I would love that. But no, not, it's been a long time since I saw anything like that in the 1031 space.
Yeah, who knows? Maybe in the future. Um, well, I think we've answered all the questions that we had. So we'll conclude here and we'll be sending everyone the recording tomorrow, along with Rick's contact info, the link to get his book. And if you want his slides as well, they'll be in there. And I encourage you guys to come to our next webinar, which is actually Thursday. So just in 2 more days. Trust no one, check them out. How to legally screen employees and property managers. If you are hiring anybody, you definitely should be screening them, but you need to be even more careful because, believe it or not, there are more employment screening laws than there are tenant screening laws. And so, if you're hiring anyone, even if you don't think, oh, I have a lot of employees, anyone, I mean, that you hire, you really need to be checking out. So, we'll show you how to do that so you don't get in trouble in screening that process. So, Rick, thank you again for all of the information. This was a really interesting take and topic. I think we all learned a little bit, something new. So, I hope everyone will watch the recording and share it. And thank you, everyone, for sticking around.
Sorry about the slide glitch at the beginning.
Oh, no worries. Kyan says, thanks, Rick. Valuable insights on 1031s and DSTs. We'll look into the next one. All right, guys. We'll see you soon. Have a wonderful day.
Bye,
Bye.
everybody.